Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Alibaba Group Holding Limited latest report. Alibaba Group Holding Limited offers a diverse range of businesses and services to cater to various needs of its users and customers. At the core of its operations are digital retail platforms such as Taobao and Tmall, which provide e-commerce solutions for merchants and brands. The company also operates wholesale marketplaces through 1688.com and Alibaba.com, catering to international businesses. In addition to these platforms, Alibaba Group Holding Limited offers a range of services including Cainiao's e-commerce logistics solution, Alemi's on-demand delivery platform, and Amap's mobile digital map and navigation service. Its entertainment arm, Damai Entertainment, provides content production, promotion, and distribution services for the industry. The company also offers cloud computing services through Alibaba Cloud, which includes elastic computing, storage, network, security, database, big data, and cloud-native solutions. Furthermore, it provides hardware, software license, and installation services, as well as application development and maintenance services. In recent years, Alibaba Group Holding Limited has expanded its offerings to include membership packages and subscriptions, Freshippo's retail platform for groceries and goods, Alibaba Health's medical and healthcare solutions, mobile games through Linksy Games, UC Browser's information service platform, Quark's information services platform for young users, Fliggy's online travel platform, and DingTalk's collaboration workplace and enterprise management platform. Alibaba Group Holding Limited market capitalization of $2,521 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Alibaba Group Holding Limited holds a significant advantage in their industry. Alibaba Group Holding Limited trades at a higher price-to-earnings ratio of 18 times and a lower price-to-book ratio of 0.26 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 40% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be identified through a review of the company's recent financial performance. The most significant contributors to revenue growth include ag-related product revenue, which has experienced triple-digit growth for 10 consecutive quarters, and Cloud Intelligence Group's revenue, both of which have seen a 36% increase. Another key driver is the quick commerce business, which has grown by 56%. This rapid expansion suggests that the company is successfully adapting to changing consumer behaviors. The Alibaba China e-commerce group has also reported growth, with customer management revenue increasing by 1%, and Taobao app achieving a double-digit year-over-year increase in monthly active consumers. In addition, international commerce retail and wholesale businesses have seen a 10% year-over-year growth, indicating that the company's global reach is expanding. The public cloud revenue has also been growing, driven by increasing adoption of AI-related products. Overall, these drivers suggest that the company's focus on innovation and adaptability is paying off, leading to sustained revenue growth. The net income of a company has undergone significant decline over the past year. According to the data, it decreased by 66% year-over-year, from RMB 46,434 million in 2024 to RMB 15,631 million in 2025. This drastic drop is also reflected in the 3-month period ending December 31, 2025, where net income plummeted by 66.1% compared to the same period in 2024. The profit margins of the company have also taken a hit. The adjusted EBITDA margin decreased from 20% in 2024 to 8% in 2025, while the operating margin dropped from 15% to 4%. These changes indicate that the company's ability to generate profits has been severely impacted. The decline in profit margins is likely due to various factors such as increased competition, rising costs, or decreased revenue. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. According to the provided information, the net cash provided by operating activities was a substantial RMB 36,032 million, US $5,152 million, in both page 15 and page 27 of the report. This consistent figure suggests that the company is successfully converting its earnings into cash flow, which is a crucial indicator of financial health. The positive operating cash flow is a testament to the company's efficient management and ability to generate sufficient funds from its core business activities. The company's debt level has undergone some changes over the past period. On one hand, current bank borrowings decreased by 9% from RMB 24,655 million to RMB 22,562 million. Additionally, non-current bank borrowings also saw a decrease from RMB 51,423 million to RMB 49,909 million. However, cash and cash equivalents experienced a significant drop of RMB 36,957 million. On the other hand, interest expenses have shown mixed results. While interest expense decreased by 72 million RMB, minus $10 million USD, as a percentage of revenue increased from 0.89% to 1.03%, it also saw an increase on page 24 and page 26, with a plus 38% rise in interest expenses. Overall, the company's debt level has seen some fluctuations, but there is no clear indication of significant change. Interest expenses have been inconsistent, with both decreases and increases observed across different pages. The performance of various segments and regions within the company has been mixed. On the positive side, the Cloud Intelligence Group has shown significant growth, with a 36% year-over-year (YoY) increase in total revenue and a 25% rise in revenue and adjusted EBITDA. The international commerce wholesale business also performed well, with a 10% revenue growth. Furthermore, the quick commerce business experienced an impressive 56% revenue growth. On the other hand, some segments have struggled. The Alibaba China e-commerce group saw a substantial decline of 43% in YoY revenue and adjusted EBITDA. Additionally, the All Others segment reported a decrease in revenue by 25%, with an adjusted EBITDA loss of RMB 9,792 million. These poorly performing segments have had a negative impact on the company's overall performance. Management is optimistic about the company's outlook, citing AI as a primary growth engine with triple-digit growth for 10 consecutive quarters. This growth is expected to continue, driven by investments in quick commerce and improvements in unit economics. The company plans to focus on scaling its quick commerce business while enhancing efficiency and customer retention. This strategic shift aims to improve profitability and drive long-term growth. Additionally, the increasing adoption of AI-related products in the public cloud is contributing to overall revenue growth, further solidifying the company's position in the market. Overall, management's strategy emphasizes investing in emerging technologies like AI and quick commerce to fuel future growth and offset potential declines in other areas. There are concerns about the potential strain on logistics and supply chain operations due to rapid growth in quick commerce revenue. The 43% year-over-year increase in this sector suggests that companies may struggle to keep up with demand, leading to potential disruptions. Additionally, a 4% increase in direct sales, logistics, and other revenues under Alibaba's China e-commerce group may indicate some inventory buildup. This could be a sign of inefficiencies in supply chain management or an inability to meet growing demand, further exacerbating the risk of disruption. That concludes the financial summary for Alibaba Group Holding Limited. Feel free to comment below, and I will be happy to answer them when possible.